Right, good. Hello, everybody. Let me start that again. Right, hello, everybody. Welcome to today's Trend Signal podcast. It's the 8th of June, 2020. And today we're going to be talking about, well, dollar weakness, very strong equity markets, and much better than expected jobs numbers last week as well. So quite a lot to get through today that's been really impacting the markets far and wide. I'm joined as ever with my colleague, Jerry Miller. Hi, Jerry.
Yep, morning. Hello, everyone.
Well, like I said, Jerry, it's been a massive non-farm payroll number. We're expecting a massive one anyway, but we're expecting to lose jobs. But it's quite a shock, wasn't it?
Yeah, it was a shock because we had the data earlier on in the week from ADP, and I've been asked by a few people who says, well, which one do you believe? And actually, if you think about it, you could believe both of them because ADP, which is that private payroll company, Adrian, that it basically does the payroll for companies, but not every company. And it posted a contraction in jobs or loss of jobs of 2.76 million. What happened with the non-farm payroll data on Friday is that the Bureau of Labour Statistics, which is a government organisation, it came out with a number of 2.5 million increase in jobs, which is completely opposite to ADP and way off where the consensus was, a total job loss of 7.75 million. And you might be thinking, hang on, they've got to have just got the numbers wrong. Something's gone wrong here. We're just in extraordinary times, Adrian, and that's the sort of thing that's happening. And it completely blew away all the forecasts. And
the thing is, even the ADP was still down, 2.5 million jobs, but it was still significantly better than expectations, wasn't it?
Yeah, it was.
It was like 6-7 million or something better than expected. So,
yeah,
I mean, as you said, extraordinary times and extraordinary sized numbers, aren't they?
Yeah. I mean, we were expecting the US to approach an unemployment rate of 20% on the back of these numbers. And when the number came out, it was a complete shock. First of all, people don't believe it. And it's like, what? That's got to be a misprint. And it wasn't, obviously. And then eventually they reconciled it. But then the employment rate, it came out at 13.3%, was 14.7%. We were expecting an unemployment rate of 19% of 19.4%.
19.
It's just mad.
Yeah.
Well.
Remarkable, and of course, remarkable impact on the stock market. So we had some significant moves on the stock market at the tail end of the week. Joe, do you want to just give us a run through of the major indices?
Well, for the week, you're right. Friday, it gave a lift to certainly US markets and European markets, with the DAX and FTSE also powering ahead. But on a week where the markets had just gone up and continued to go up in a relatively straight line, as you can see, that's the FTSE. Same thing with the S&P, same thing with the Dow that you're just showing now. I mean, look at the gains. It was stellar gains, but the best gains we've seen probably for 3 weeks. But on the week, the Dow, 1,584 points up, Adrian. That's 6%, above 6%. Remember, it's just 30 components in the Dow, so it tends to be not quite in line with the big market, the S&P 500, which is 500 stocks as opposed to 30 in the Dow. But that was still up 131, and that was just shy of 4.5%, which is huge. But the standout market, and we were talking about this last week, because the FTSE doesn't have any tech stocks, so we're going to continue to lag, even with our Brexit negotiations hanging over us. We lag because we're sort of rather dominated by, as we said, oil and resource stocks, miners, and the like. But the DAX, 1,100 points higher last week, by far and away the best performer. That's close on 9.5% rally. But for me, I tried to explain this to people. We tried to look at the numbers, and you can't look at the economic data. The reality is bad at the moment, but these markets not ignoring reality, but they're just being optimistic, and they are forecasting and predicting the way they're behaving a swift recovery, a V-shaped recovery, I'd say. Not a shoo-in, but that's what they're predicting.
Well, but look how far away we are from the highs now. Obviously, it's around the 20th of February that it really started to kick off, wasn't it? And there we are, we're only
Yeah,
1,000 points. What's that, sort of, I don't know, 7 or 8% off the
yeah,
highs on the DAX,
6.5,
something like that.
6.5%. Yeah, you're right.
S&Ps, similarly, probably about 5% off the highs now.
Yeah, yeah.
Staggering, actually. You consider what actually we went down. And what I've also found quite interesting, just sort of reviewing the sort of longer term moves on some of these markets or economies that we thought would really struggle with this, were the likes of the Australian dollar.
Yeah,
That currency had a significant fall from February, really sort of
yeah,
gathering speed in March. But look how much higher the Aussie dollar is against the US dollar now.
yeah,
And you can see that across most of the currencies. You look at February's around this sort of point of the chart.
mm,
You know, it's trading higher on pretty much everything against pretty much everything else
yeah.
compared to that.
Well, I think the view generally amongst forex traders is that the Australian economy, along with the New Zealand economy, they managed to dodge a big impact from the pandemic bullet. Don't
They
get me wrong;
did.
they've still had to go into lockdown, so it's been tough, and they are going to be in a recession. But everything's comparable, and I think you look at what the Australian and New Zealand economies have done, and they've done well.
Yeah.
As to whether this is going to be maintained in the longer run, it really depends on demand from China. And remember, Australia basically
Well, that's
generates
right.
all
They're
its revenue from China selling.
heavily correlated to that. So I'd say the
Yeah.
reaction of this is more to do with the speed in which China recovered than perhaps so much about Australia itself, probably. I
Yeah,
don't know.
I'd say that, and I would suggest that it's also partly now down to this dollar weakness that you referred to at the beginning of this piece. So yeah, but it's impressive. When you're looking at it when it was down at 115, 120, you wouldn't have thought it'd be here by the
No.
time 3 months later. But here it is, extraordinary.
Yeah. Yeah.
Yeah,
So
but I
there
mean,
was a big move on the dollar.
another.
Sorry, go on.
Yeah, well, I was going to go back to currencies, to indices as well, but you're right. Well, let's get on to the dollar in a second, because the other thing I wanted to point out with the S&P is that it's 40% from the lows. Of course, this is from rebounding back up, which is the most extraordinary thing going. And of course, the other reason why markets have done really well last week, remember the ECB announced that extra QE increase, which is just, I mean, by any measure, is just huge. 600 billion. That's on top of, I think, was it the existing one was 750 billion of QE, but that
Yeah.
was due to run out at the end of October on current sort of spending by the ECB. So they wanted to comfort the markets with that. But remember, the other thing that's happened is they've got this fund. So the ECB is going to be issuing bonds in the name of the member states. And now, classic European Eurozone, there's now an argument about who should receive what, because it's based as each country's population and in their relative GDPs. So yeah, it's just classic. But anyway, it's done a world of good. Markets love it, and as I say, thanks to the largesse of governments and central banks, these markets have just powered ahead. I mean, one thing you might be concerned about though is if you're a market watcher and market participants love all this largesse, I'm not sure that the Fed are going to be running to add any more stimulus measures to the whole thing, looking at what happened with non-farm payroll last Friday. Do you?
You would think not. I think they're probably just going to sit back and watch a little bit. I would think.
I'd say that would
Wednesday will be interesting because we've got the Fed statement, haven't we, on Wednesday? I think it is.
Yeah.
So let me just bring up the calendar very quickly. Yeah, so we've got the economic projections Fed statement as well on Wednesday evening. We're sort of jumping around with the sort of usual order of things, but it's going to be about what they say, isn't it? Because we're certainly not going to expect them to change the rates. That's for sure.
No, they're not going to change the rates. B, I think they're unlikely to engage in any other change to monetary stimulus that they've put into the markets, put into the system. And I think, as you just said, Jerome Powell and his committee, I think they're going to wait and see now. There's certainly no need, looking at the stock market performing, and the dollar and the dollar's move as a consequence of lots of things we can get onto in a second. But certainly, I think the interesting thing on Wednesday evening, Adrian, will be at 7:30 when Jerome Powell has a sort of online press conference, and that'll be interesting because I think the markets, we would love to know what he thinks about the pickup in employment, because the Federal Reserve would have had the same consensus from the rest of the market, thinking there was going to be a big sort of, another significant fall in employment or increase in unemployment, and the opposite happened.
Yeah.
And also, I'd love to know what they think about the current dollar weakness, but I'm not allowed to ask any questions. I hope someone does.
I'm sure they will. I'm sure they will. Okay, so currency-wise then, so really a bit of a slip in the dollar really last week. You can see, if you look at, say, pound dollar, you can see quite a big rise in the pound, even with the Brexit sort of talks going on. We'll talk about that in a second. Euro dollar, euro rallying significantly against the dollar in the last few weeks.
It's a good proxy for the dollar index, the euro. I think it's about 56% of the euro dollar the dollar index basket. So that pretty much says what's going on with the dollar. It's weakening quite a lot. And we mentioned last week that the tide had turned, that more people were the most bearish on the dollar now since beginning of March. And it's something that a lot of analysts called for at the beginning of the year before the pandemic started, which is quite interesting. So on the week, I think the euro gained close on 2 cents against the dollar. Sterling, just over 3 cents against the dollar. So a significant improvement there. And for all those doomsayers about sterling, which could still come to pass, but for now, sterling, put in a monster performance.
Well, particularly if we still don't really agree much over the next month or so with Brexit. I mean, I guess that could have quite a negative impact on the pound. We still haven't really recovered from nowhere near recovered from when it all sort of got voted through in the first place back in
June 16, No, it dropped sort of 20% in 3 months, didn't it? But I think that was following the referendum in June that year. But like most currencies, the pound's rallied, and it's gone past that 125 level, which I think is quite significant. I mean, the levels we hit earlier on today were the levels we last hit as we were falling sharply against the dollar at the start of the pandemic, when we fell from sort of 131 down to below 115. I mean, honestly, it looked like someone had pulled the plug out the bath when that happened. That was a right old tip out. But I think we wanted to talk about Brexit, or we have mentioned Brexit a few times, and I feel like we're sort of winding the clock back now. We sort of left Brexit and we were on pandemic mode, but Brexit has come back again to haunt us, Adrian. The talks ended last week. Not much progress. Both sides really are trying to defend these red line positions, about maintaining a fair, level playing field as the mantra.
Isn't this always the way though? They sort of defend until they someone sort of caves in, or both cave in, at the 11th hour.
They are. I mean, especially the EU. The EU are masters of just pulling out a deal at the 11th hour, and it's almost like we've got a whole year to negotiate. I'll tell you what, let's just turn up for the last week of December and get it done, shall we? It's almost like a complete waste of time, but it's not a waste of time because a lot of chat's had. But the UK has basically ruled out an extension to the to this sort of interregnum period, this period where we have left the European Union, but we're waiting to secure a trade deal, and we've set our own deadline here in the UK, the 31st of December, and the UK has basically ruled that out in terms of extending it. So it'll be 31st of December, whether we have a deal or not. That's it.
I think as a currency trader, I'd sort of support that, because otherwise you end up with this sort of can being kicked down the road constantly. And of course, what happens is that the market reacts then suddenly to any little news bite that comes out, and you have a big jolt in one direction for one day, and then the market will sort of stop, and you sort of lack much follow through. And I think if we can just put this whole thing to bed and let the markets just do what the markets enjoy doing, which is turning, rotating, extending, and allowing us traders to get on some proper moves.
Having a more pure market rather than driven by news, rumor and counter rumor. I absolutely agree, Adrian. But I also think politically, we talked about the way the EU negotiates. If you just said, okay, well, let's kick it down the can down the road for another 9 months, it won't be done until close to the end of the extra 9 months. You've just got to have a finishing line. It's got to be now. And I think, I don't mean now, I mean, it's got to be 31st of December, and that's it. We don't move from it. Focus is everyone's mind. That's it.
Yeah, exactly. Okay. What about the commodities, Jerry? Obviously, oil, gold rather, tends to move the opposite way to the indices, doesn't it? As that sort of risk on sort of moves came in last week.
Yeah, that's right. Gold is traditionally referred to as a safe haven. So when we've referred to this phrase risk off, risk on, risk off, when people, traders, investors are taking money out of their investments, selling riskier investments, which are equities, and putting them into bonds, sovereign bonds, which are very low yielding and not going to give you much of a return, in fact a negative return if you're not careful. And the dollar was always regarded as a safe haven, and so is gold. But certainly in the face of the significant rally we've seen in equities, gold has struggled, even on the back of this weakening dollar that we've seen over 8 trading days, Adrian. You'd expect gold to have perhaps picked up in the local currency in terms, but it hasn't done at all. And I think this strong and non-farm payroll data was the final straw that broke the camel's back. Although it has been rebounding a little bit this morning, isn't it? So gold is, back up sort of $8 or $9, but Friday's was the lowest close since late April. I mean, not a million miles away, but yeah, it's sort of it's definitely it's starting to make lower highs, if you know what I mean. And if it does take out, I suppose, that low from just there, or around those sort of areas there.
Low from April there. I mean, there's quite a bit of freedom to fall if it takes out that sort of 1659, 1658 area there. So that could lead to quite a big fall in prices. But again, that's really a function of what happens on the equity markets. Really, I would say.
Yeah, I'd say.
Okay, and oils?
Oil, yeah, wow. Well, what can you say about oil? Oil, OPEC Plus, which is OPEC plus Russia. They've agreed that cut in production of 10%, which was way too little before the market completely melted and effectively went negative. But it wasn't the price going negative; it was the storage cost creating a negative scenario. But they've agreed to extend the production cuts for a further month, which you might think, what, a month? What good's that going to do? But just to remind everyone that the cuts that were agreed in April of 10%, it was originally envisaged that they would gradually ease those cuts, i.e. cutting the cuts from 10 million barrels a day to 7.5 million barrels per day. And I think they've just decided not to start cutting their production cuts, if you know what I mean, and they're going to keep them where they are for the time being. And it's just interesting, there's been what has been described as if you take an average price around, where it was 3 months ago, 2 or 3 months ago, it's gone up by a 4-fold increase in prices since late April. So that's 2 months really. So 1.5, but it's just an extraordinary move. But the thing about all of this, Adrian, is that US shale oil producers are waiting in the wings to increase their production. And that's exactly what's going to happen. And it must be a little bit frustrating for OPEC, because OPEC basically have had to weather the storm, cut production. But of course, they're a cartel. And in most countries, it would be illegal. But they're doing it for their own benefit. But the benefit also is on the US, because the US shale oil, US production is probably the largest in the world now. And so the US shale producers are expected to increase their production by 20%. So 2 more million barrels per day of production are going to come into the supply chain at a time when, OPEC were thinking about increasing their production. as well. So it's something they're just going to have to tread very carefully. But of course, OPEC don't want the US increasing their production, but of course they've got absolutely no powers over that. Thank God.
Well, we've said before about it's actually quite expensive to produce shale oil, and what did you say? Something like $50 a barrel to actually produce it. But of course, as the prices get up towards those levels, and I'm sure there's heavy subsidies that are going on and so on. And of course, they're going to want to increase production because suddenly it's just more profitable or less loss making, perhaps.
Well, they talk about the average cost of production being somewhere between 40 and $50. So as you say, approaching $40, $45, things get quite interesting. And I think they need to take what they can get, because the shale oil production in the US is going to struggle later on in the year, because in the wake of $5-10 barrel per oil price per barrel, they've had to suspend and cut a lot of their new drilling for later this year because they've run out of money. And because they've suspended and cut a lot of this drilling, their production is going to fall away towards the end of the year, because that's how it works. They continually need to be drilling for new oil, exploring for new oil, and all that fracking is expensive. But it constantly needs new investment. So it's a bit of a tightrope between production and revenue in terms of the price of oil. They've got to think a long way ahead and hope that the price stays up.
Yeah, absolutely. All right. So what about we'll move on to the calendar for the week ahead in just a second. I think one thing that I think the listeners would probably like to hear a little bit more about, Jerry, is to do with the recovery. We've seen the rise of the stock market. It's a little bit more V-shaped than I think most people were expecting. Certainly not a Nike tick. So what does that mean? Does that mean that the economy is going to be recovering into the same extent as the stock market, or are we following a different sort of different plan? Really, with the stock market?
It's difficult to believe wholeheartedly in what the stock market's telling us all. I mean, you think as it approaches, what are we down? Just over 1% down on the year. And it's extraordinary. And yet we've suffered a pandemic and a global lockdown that has created economies, and the effects are going to be as bad as the Great Depression from the 1930s, except in the 1930s they didn't quite understand what they should and could do to recover the situation. Of course, QE didn't really exist then. But you'd think that everything was going to be over very quickly here, and that we're on for a V-shaped recovery. And I think it's probably looking more likely. And do I think it's going to happen? I'm still not sure. I just think it is slightly more likely, but I'd say probably the best description is far from certain. And what you see in the stock market is just pure optimism.
And of course, we're only seeing an average, of course, in the stock market. You're seeing that, the certain companies are dragging the whole index up, whereas actually a lot of the companies are still not doing very well with their share price.
Yeah, a lot of them will. We discussed that last week. There's 30% of the constituents are down 20%. Yeah. You have to look at any remotely connected with the travel, leisure, hospitality industry, Boeing, Rolls-Royce, all those companies associated with it absolutely killed. All the airport operators, bus manufacturers, train, the whole world, huge. Yeah. And you're right, it's far from clear. And that's why a lot of hedge funds, as reported in the EFT over the weekend, are preparing for another dip. Yeah, which probably is the reason why it's still going up.
Yeah. Well, do you know what, Joe? We've talked about this, and I looked at some of the subject lines over when we started the podcast back in October, and one thing that keeps coming back is there is no alternative, and well, there isn't. So that's just the reality, and there continues to be no alternative. In fact, there's probably fewer alternatives now than there were back then, because rates are even lower now, interest rates. Well, and then money somewhere, then they've just got to be very careful about which stocks they are, and that's actually what's happening. They're putting it into the stocks that are doing well.
Yeah, that's right. I mean, you ask, is a recovery obvious? I don't think it is obvious. I think the counter argument is stock markets reflect optimism, but the reality is that all these readings we look at when we look at the calendar, they're really ghastly. They're horrendous, deep in the red. Governments have borrowed massive amounts of money to offset the effects of the pandemic. We've talked about how generous the packages are in the US. There are a lot of people who are on in benefits out in the US who are earning more not working than when they worked. How you wean those people back off, I'm not sure, but I'm sure they'll have a way. And interest rates, central banks, they've cut rates where possible. Even negative rates have been discussed here in the UK. In fact, our money markets are forecasting negative rates March next year. I mean, it's just extraordinary. And the US have ruled it out, but the fact is, you would have never had the discussion about this a few months ago.
Yeah, the thing is, you can rule it out, but that's not to say it's not going to happen. We're just trying to put a positive spin on things, really, aren't we?
We're not so weak that we're going to need to do that. Well, I think
until
even our bond
until
we do need to, and then it's a sure, yeah. But our bonds have joined the ranks. That's the UK bonds, gilts as they're referred to, have joined the ranks of negative yielding bonds. And there's something like $17 trillion worth of sovereign bonds globally that give you less money back than what you used to buy them with. It's the most extraordinary. Talk about Tina. There is definitely there should be an exclamation mark after. There isn't an alternative, and that's of course
no alternative to tech stocks. We should just use the acronyms now.
But that's what central banks are trying to do. They're trying to force banks, institutions to put their money to work and not sit on it and hoard it, which is an expensive business that will actually cost you money and gives you a negative rate of return.
Yeah. Okay, so shall we let's move on and just finish off the session, Joe, by looking at the calendar for the week ahead. We've looked at a couple of these bits already, but what are we talking about as the main events that are going to likely to impact the currency markets and the stock markets this week?
Well, one event that's already happened is the UK quarantine rules come into force today, which I noted on the BBC website in the business section that Michael O'Leary has referred to it as a stunt by the UK government, i.e., how's it going to be enforced and et cetera, but it's like a lot of rules. Sometimes they can't be enforced. Look at all the people demonstrating for Black Lives Matter in the UK. No more than 6 people allowed to gather together at any one place, and Dominic Cummings was vilified for doing what he did. And for some reason, all of this has been allowed to happen, and people have justified it by saying that racism is a pandemic as well. I don't know what to say about it, but anyway. So the UK quarantine comes into force today. Also, we've got
as far as the Ryanair boss. It's really a case of just trying to stop people from wanting to come here in the first place. So if that dissuades 60% of the people that would have flown here, then maybe that's just done enough what it needed to do. Because you're right, you're not going to stop everybody. Not everyone's going to do that home quarantining or whatever the rules are. But at least it might put people off to say, actually, there's no point, is there? Let's have a Zoom meeting instead, shall we?
But Adrian, it's quite tough on the UK tourism industry because they basically have got to get fat in July and August. That's where they make all their revenue to survive for the rest of the year, pretty much. And if these rules have come in now, anyone who's making plans for July and August is going to look at the UK and think, no, I'm not going to go there. I'm going to have to spend 2 weeks in quarantine. So even if Priti Patel does lift this in a couple of weeks or 3 weeks or makes allowances, it might be too late. I don't know. Maybe not.
We'll see. Yes. Okay. And the calendar?
Canada really, after non-farm payroll week, the following week, it's all a bit thin on the ground, really. But the first thing I've got to just talk about is probably Christine Lagarde, the chairwoman of the European Central Bank, as you can see there. She's in one of these socially distanced Zoom presentations, and this is to the European Parliament Economic and Monetary Affairs Committee. So it could be quite interesting. Anything that she says about the European Eurozone economy and the action that the central bank are taking, and also the likelihood that they get this bond issuance away if they can raise anywhere between 600 and 750 billion in support of the European economy, and that's another reason why the euro is rallied, of course. So that would be interesting. The next one, nothing on Tuesday really, or nothing that I care to talk about in this time left, but Wednesday is an important day. We've got inflation data out of the US. That's the consumer price index there. If you just see that, that's it's the core one we look at. That one excludes the more volatile food components that can cause it to be a bit erratic, but doesn't look good, does it? CPI. We need every economy needs a modicum of inflation to be able to raise prices. Business people love to be able to plan and also raise prices, and then they can invest more in their business. No inflation, not good, I'm afraid. Not good at all.
Yeah, that's true. But then, of course, a big chunk of that fall would have been down to oil prices.
Correct.
And so on. And actually, I imagine a lot of the recovery is, well, oil prices as well. So it'd be interesting to see it without oil, I would say.
Well, the oil price affects plastics, affects, and a lot of the major costs is logistics, delivery. That's right. Yeah. Anyway, and the Fed, well, we talked about that already. The FOMC meeting on Wednesday, culminating in that press conference at 7:30. That's the thing to stick around for if you're wanting to see a bit of market reaction potentially. That's certainly potential.
So day traders, just be a little bit careful on the announcement times. That's all. As we start to, as traders digest it, that's really what we'd say there.
Yeah, for sure. Thursday, we've got something called the PPI, something that not everyone looks at. This is the producer price index. So that actually is the cost of goods going into production. So CPI is the cost of those goods and services that people pay for. This is the cost of of goods going into that production, and often it's sort of regarded as a bit of a leading indicator to inflation. And of course, if you look at that, you're just going to think, well, there's absolutely no chance of any inflation. You'd be right. There isn't any chance of inflation, not for now. Although all this government spending that we've seen happening across the globe, that might come back to haunt us in a few years. And then and Friday, a bit of UK stuff, actually. We've got the monthly GDP data. It's something that we never really looked at before because it's the quarterly data that we rely on. But 40 days after the month end, they get to publish the monthly data for April, which is the first month of the new quarter, Q2, Adrian. Yeah. And I think it's just horrendous. Minus 18%. I feel like taking a picture, a screenshot of this, because it is. We will not see this happen again in our lifetimes. I'm sorry, we won't.
Well, you see the scale, going back a couple of years. I mean, I don't know if we can go back further. Probably can't, but just the magnitude of the fall compared to what it has been.
All of it. The rest of it just looks like a flat line, doesn't it? Until you get this.
There's so many charts do. They're so distorted by these recent numbers. It's remarkable.
But we won't see this again. There will not be. There may well be more pandemics, but we're going to be prepared for them next time.
Yeah.
And this is the reason why economists like Singapore, like Hong Kong, have done relatively well in combating things because they're used to dealing with, MERS and SARS and things like that. So, this just, it's one for the family scrapbook, Adrian. You can tell your grandchildren in the years to come, oh, I was around.
I bet they can't wait for that conversation.
Granddad, tell me about the GDP back in 2020. I want to know. Yeah, I can see that. I can see that bedtime story, Adrian. Anyway, manufacturing production also in the UK, a minority of overall productivity, but still important in that most of our, productivity comes from services, but a pretty dire reading, nevertheless, 15.5%. Question is, how quickly is this going to recover? And then a little favourite one of mine from the US, the preliminary reading of the consumer sentiment from the University of Michigan, which, the whole premise, the reason why it's so important, it's a good leading indicator. If consumers are happy, consumers spend money. When consumers spend money, companies that sell them those services and goods receive more revenue. If they receive more revenue, they can make more profits. If they make more profits, companies are happy and the economies are happy and governments are happy. Yeah. So it's good to see consumers recovering their poise a little bit, but it's only a modest bounce. But hey, it's a start.
Well, it'll be interesting to see how people feel after the non-farm payroll number. That might give a bit of a boost to it. Who knows?
Yeah. Well, of
Probably
course, the
not
other thing.
after all these riots, but you never know.
Yeah, well, that's a good point actually. That those riots are not helping sentiment at all. But I think you know a lot of consumers, unlike here in the UK, they check their stock portfolios quite regularly, and the improvement in the stock market, certainly as it's continued over the last month, will bolster sentiment significantly, in my opinion.
Yeah, absolutely.
So, and maybe it will help Trump get re-elected, but he's still 10 points behind in the opinion polls, even with the stock market doing what he's doing.
Yeah, we'll see. Lots of interesting stories and accusations to come until November.
Well,
I think.
Someone suggested that his wife should hide his phone at night so he can't get onto Twitter and make a fool of himself. But that's
Well, perhaps it's that got him elected in the first place.
Well, I was going to say that's probably part of the formula. Yeah. At
Yeah.
least that's what he thinks. But yeah,
Remarkable time for politics, that's for sure.
Isn't it?
Right. Okay. Well, I think that's pretty much it, Jerry. I think.
Yeah.
Would we agree?
Yeah, that's the end of the run on the calendar this week. It's a lightish calendar this week.
Okay. So just a very quick blurb at the end. Then really, we've got. We're going to be putting some of this knowledge into practice. We're looking at some of the strategies in our live events this week. We're running 3 events this week that we'd love you to come along to. So if you'd like to find out more about us, how we teach our traders to trade the markets more effectively, then we'd love you to welcome you to one of our upcoming live trading webinars. We've got a few, as I say, this week coming up, and you can find them and the schedule on our short link here, which is bit.ly, so bit.ly/learnts, and you can come along, book a free place on one of our live trading events, and we'll teach you one of our favorite trading strategies and show you a bit more about how we do things here. So we'd love to welcome you along there. So bit.ly/learnts. Otherwise, everybody, have a great week's trading. We'll be back as usual this time next week for our next podcast. So keep the risk nice and safe, guys, and we'll see you then. Bye-bye for now.